You're listening to the Real Estate Runway Podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, friends, today we're going to talk a little bit about what closing in today's environment looks like. Yes, Quattro Capital always gets it done, but some folks are not so lucky. There are some times where you need to know when to back up from a deal, and there are times when you need to press through and you need to just figure it out. This story we're going to go through is one of those times. The asset was great, the fundamentals are great, and we just had to figure out how to navigate a changing debt market. So without further ado, we're going to get into that story, hopefully provide some nuggets for you and your investing career or your operating career. And as a reminder, if you get any value out of the show, please leave us that 5-star review and thoughtful comment. Those are the main way we grow the show. When you speak, that you appreciate what we're putting out. So thank you for that in advance. You can also follow us at our parent company, Quattro Capital, on Instagram, Facebook, and LinkedIn at Team Quattro Capital, one word, no special characters, or by visiting us at thequattroway.com. And we really appreciate all of you. So love to hear from you. If you have any feedback, requests, content requests, things of that sort, podcast at thequattroway.com. Love to hear from you. And if you want to apply to be on the show, thequattroway.com/podcast. And now, on to your scheduled production. All right. Real Estate Runway family, Happy New Year as of this recording. Welcome to another episode of the Real Estate Runway Podcast, Quattro Roundtable Edition. I'm joined today with my lovely partners, Erin, Kim, and Tammy here at the Quattro team. We miss you, Mo. I know you're having a good time with your family this week, so he'll be in here in spirit. But today, I really want to tee up a roundtable conversation around today's lending environment. A lot of people post deals that are being closed and raw awesome stories on Instagram and LinkedIn. But I love to open up the hood, pull back the curtain a little bit, and let's just talk a little bit about some of the challenges that exist in today's lending market and how fast those things have changed and what parallels we can draw to, the environment we experienced as recent as 2020. So without further ado, let's get right into the conversation. Welcome to the show, ladies. How are y'all doing today?
So good. We're excited to be on here today and talk about our recent close in this crazy wild market that we're in right now.
Yeah. So maybe to lead it off, Kim, if you don't mind kind of dropping some nuggets here, because, we lived in the recent seizing up of the debt market in 2020. In your view, what similarities can we take from what happened in the COVID related debt seizure of the market as to what we're seeing today? And is it the same? Is it different?
Chad, you're so right. That is absolutely the key, is to understand the cycles in the debt market, because the debt market has cycles too. I like to call those cycles drama, because if you look at the last 3 years, in 2019, 2020, 21, and 22, we have had debt drama. It began in 2019 when Fannie and Freddie literally ran out of money and nobody could get an agency loan in the fourth quarter of the year. They kind of cut their rate by 1/4 of a point when they came back online, kind of as an apology to everyone. But that was a big part of why we had to close a project in January instead of November. So there's debt drama all the time. 2020 was an opportunity for the world to understand how the debt market worked. And if you were trying to close a project in March of 2020, you know exactly what we're talking about. But if you didn't, let me share. Here's how it went, because it was all of a sudden the entire thing seized up in literally 30 days. So we had a loan, we were due to close on March 16th, both the debt market and the bond market fall. All of a sudden, the lenders who are lending on debt can't lend anymore. And from that point forward, the lights start going out in every type of lenders group. When they were coming back online, which happened later in the third quarter, when they were coming back online, you saw them come back online in a particular pattern. We saw the pattern, we learned to play in that world of 2020. 2022, we're going to flash forward for time's sake. 2022 was the exact same pattern, but instead of happening in weeks, it's taken about a month and a half to 2 months, but it's the exact same pattern. And because we lived through the crucible of 2020, we knew how the playbook had to flow and the chaos that was coming in all of these sudden rate changes. So I'll turn it back to you and Erin and Tammy, because I know you guys have just lived the most recent close.
Yeah, I think where I'd love to take it next, if you don't mind, is I'd love to take it over to Erin. And let's really, a lot of operators and investors who invest with operators are listening to the show right now. Can you talk a little bit about, the resolve, the mindset, and the can-do attitude, just the innovative attitude you really have to have, as opposed to woe is me, things are changing under my feet, what do I do, in order to survive in a changing debt market?
Sure. No, that's great, Chad. I think for us, we have a handful of investors we've been working with for quite some time. And for a market like this and all of a sudden debt terms changing, you really have to have really strong relationships working with people that know you, like you, and trust you. And at the end of the day, when you have investors that are coming back to you time and time again to invest in a particular deal, they know, or I should say our investors know, that we truly have their best interest. So we're not going to move forward on something that doesn't make sense, that's going to put them in a vulnerable position. And at the end of the day, Quattro Capital truly is a team that is really going to take care of their investors and do what's right. If it means that we have to take the risk and the hit if something falls out, I can assure you Quattro Capital will do just that. So it's been an interesting one for sure, but thank goodness that we have wonderful investors that have linked arms with us and they know what we're capable of and what we will and will not do. So I guess that's how I would sum it up with our investors. It's a pleasure to work with them.
I love that. And, to kind of take it back a little bit, and Tammy, I want to come to you here in just a second about the deal we've just been through, one of our recent acquisitions with, in a more rapidly changing debt environment than we've, I think, experienced in our lifetimes, but, or at least our real estate lifetimes. Thinking back through what we've experienced over the last couple of years in these different debt cycles, there's always one thing in common, and it is, okay, the sand shifted under my feet. A, do I still like the deal? B, how do I repair the deal? And C, what has to change? So in years past, I think what we've been able to do is it's been changing slow enough that we're able to pivot to another lender and find comparable, if not better terms, perhaps renegotiate the price a little bit, because if the cost of capital changes, everything is now fluid in the deal. So you have to be willing to take that negotiation hit. But, in a time where here in 2022, things changed so rapidly, and just to give context to the listeners, we've talked a lot about inflation and interest rates and the Fed on this show, so I won't belabor that here. Listen to recent episodes for that context. But we have literally gone from effectively a Fed funds rate of 0 to a Fed funds rate of 3 and 4% in a matter of months. And we have not moved that fast, for context, since the 80s, when, back in the previous years of the Federal Reserve, when we had, to combat inflation in years past. So and for context, if you look at the rate chart, we're just going back effectively to where we were back in 2019. We dipped to 0 when that global event called a pandemic happened, and we just very rapidly came back up. But what happens? It takes nearly 90 to 120 days to complete a real estate transaction at some of the levels that we're playing. And so you go put something under contract, you execute on a loan, you spend about 60 days with them, underwriting and evaluating and going through due diligence. And if every 30 days of that 120 days the rates move 75 basis points, you are now 3% different than when you started. And so it's a highly volatile environment. So just kind of reiterating the context here, but Tammy, maybe over to you a little bit. We just closed a large transaction. It was our second large transaction in this environment, so we could really pull from either one. But what are some of the keys to success that you saw along the way as we had to, pivot, reevaluate, and continue to make sure this was the right move?
Well, the one thing that was coming to mind a minute ago when Erin was talking about what she was is the fact that it was very important for us to have the ability to take a different play out of the playbook. We could not sit there with our business plan and just keep it concrete through a whole deal when things like term sheets are becoming fluid documents. That was one thing that I was like, wait a minute, that's not what was in the term sheet. And, here we are having to pivot and adjust as the offense was pivoting and adjusting. But what was more important to us as Quattro was that we didn't compromise our core values and our principles, and keeping the investors as the utmost priority, and making how many times, I can't even tell you how many times we all went back to the deal to make sure this thing still worked and we were still good with what we had, and we were still the fact that we ended up with a better deal at the end than what we even did in the beginning. It was wow. That was pretty impressive. But going through two of these in 2022 with the sand, like you said, the sand shifting under your feet and the tide coming in quicker and all that good stuff, it was just uber important that we stayed on top of it and made sure all the puzzle pieces still fit. So that was, and like I said, when the rules are changing, you just have to make sure stay on the offense. So defense, whichever. I'm not a sports player,
That's awesome. Well said, Tammy.
Yeah, and I think what's important, is to remember, everyone of the listeners here knows I have ridiculous analogies, so here comes another one, right? A deal that is being acquired is like a Mr. Potato Head that is made of Play-Doh, right? Until it is purchased, you can literally pull the nose off, stick it in the ear socket, mold it to a skinny potato or a fat potato. Like, you can do all sorts of things with this Play-Doh until the Play-Doh hards, right? Don't laugh too hard, team. But my point in saying that is nothing is fixed on the deal. So if the sand starts shifting under your feet, you have to realize that if the debt market is shifting that quickly, the condition of how much of a seller's or buyer's market is at present is also shifting. And so what you have to remember is, you can still go back, and in times like these, it is permissible and understandable. I mean, nobody likes the conversation, but it's a real conversation. You may have to renegotiate price. And ultimately, the only way we bought the deals that we did this year was we had to renegotiate price because our cost of capital went up. And so that wound up making it, still a good deal. And then we were able to further optimize our debt structure. It makes you get a little more creative with your CapEx budgets and kind of dial in a little more scope up front and make sure you really understand what money you're putting in and what it's going to yield. But overall, we have to remember the horizon. We're investing for the horizon, the 5 to 10 year horizon. We're not investing for something that's going to yield, a ultimate profit and sale in a year. And so realizing that, I'd love to hear y'all's take on this, after I get off my soapbox. Go ahead, Kim. I see you jumping in there.
The point you're making is so good. I just want to stack on a concept.
Stack
it. When you're talking about going back to sellers and renegotiating, like, that has never been in the Quattro playbook. We never wanted to be the retraders out there, because that's actually poor underwriting. The difference in this climate, though, is that because the lending terms were changing so fast when the Fed changes the interest rate, that directly affects the value that can be acquired in terms of a loan. So just because the interest rate changed doesn't just affect payment and the rest of it, it changes the value that can actually be created in that loan. And so, be careful if somebody's new in the space. the principle of please don't retrade, that's bad business, still applies. But this was extreme circumstances.
That's right.
Oh, and before I leave that, Chad, would you please share with everyone the intelligent move that you and others made when you literally went and sat down with the brokers to help them understand the impact of what was happening, because they didn't understand, right?
I do want to have that conversation. Let me quickly take Tammy's point while it's in context. Was that a stack point, Tammy, that you were jumping in with?
A little bit. The one thing I wanted to reiterate is, our team and the people that we choose to do deals with and things like that are the top of the top, and now more than ever, the lenders are very critical and very, they always had a microscope as if they were looking at deals, but I kid you not, they've zoomed in even more. And literally who you are doing your deal with is probably more important than anything else, because lenders are looking of who they can out, who they cannot do the deal, reasons to not do the deal, because they have to protect themselves as well. So the one thing that I felt very comfortable and prided our decision makings on of who we do business with was that was never a question with our lenders. Everything was on the up and up. We were very forthcoming. We were very transparent. There was no skeletons, things like that. So that's just my little, tidbit advice is, with a moving market and sand under your feet, you make sure who your team is very solid. So
that's a solid point. And so bridging into the point Kim made is part of your team or the brokers you're working with, whether they're representing you or they're representing the seller, they are the glue that holds that transaction together. And 100% of the time when we've had a transaction go south, the broker being present and engaged and on both of our teams is really what happened to keep it together. So what Kim is alluding to is, Quattro does not retrade. And the reason we don't do that is we put a lot of upfront work. We invest the time. We know what we're offering on. And when we put something on paper, it sticks, right? Unless, a major driving force that you have taken as an assumption, or even you have a tolerance band around it and you blew that tolerance band because of what actually happened in a cataclysmic event, that is something that we have to actually go back and say, hey, we have to reevaluate. And so how did we do that? First thing is always remember you're negotiating 100% of the time. Even if you're talking to your kids, it's always a negotiation. So have that frame of mind. But in my household, that's probably the most intense negotiations that I have, but I'm neither here nor there. So what did we do? When we decided we had to make this change, we finally came and got all partner agreement and said, okay, we're going to get on a plane. We're going to go to Houston and we're going to have the conversation face to face, right? And in doing that, nobody else did that. Everybody else was a phone call, or they just ghosted, or it was very impersonal, very business. We went down there. We're the only group that showed up with treats and said, hey, we got to talk. And so that went over very well. They expected the conversation, because actually the day that we did it, they'd had about 10 calls that morning. So they walked in the room black and blue and beaten up, right? Because their pipelines were just evaporating. And first of all, we said, we're still committed to the deal. We want to do the deal. But here's what's transpired, run your numbers, but I think you will agree that this is a challenge. And so it was a very collaborative situation. In this case, not every broker is very savvy in this, but these were very high-performing brokers in the state, and they knew what was going on. This was about their 10th call or I guess we were number 11 that day on this kind of discussion. And so we sat across the table. We looked them eye to eye. People do business with people they like, they know, and they trust, right? If you have eye-to-eye contact and you're having a relationship, they were in the boat, and they wanted to for their sake and our sake, they wanted to help try to make this work. And so getting the broker of the transaction in your camp, or at least 1 foot on yours and 1 foot on the seller's, that was the catalyst that helped him go start to work on the seller and use his data and all the other experience and start to realize things have changed. If you want to sell this transaction, here's how we're going to have to do it. Now we have to eat equal pain on that, but here's how we're going to have to get it done. And ultimately it worked out in our favor, because we were able to secure substantial, like to the tune of $4 million price reductions on these deals to get them done. So, yes, can't stress enough that relationship is key on success here.
And Chad, I know we need to land the plane. The fact that real estate is relationships, right? Right. And one of the most important relationships in a crisis is the relationship with your seller. Or if you're the seller, the relationship with the buyer. Because there are times when you just have to make decisions. And I would love it if you shared with folks a little bit about your philosophy on how you keep those difficult conversations moving.
Yes, and I think that relationship was key. Sometimes you have a phone relationship, sometimes it's email. This was email only. They didn't really like to get on the phone, which is fine. And they read everything we sent, but they didn't always respond. So we could track their read receipts, and we knew what was going on. And in most cases, they were reading our emails within 30 seconds of being sent. So we knew they were hanging on every word. But we really had to craft every communication. We had to be hyper communicative, right? What you don't want to do, and I'm on the other side of this right now, right? You do not want to have your buyer ghosting you and just not responding. That is the worst thing you can do. Be open, be collaborative, so that you're not, when things change, you're not slamming a huge change in front of your seller. Prep them. Pre-frame the issue. Let them know little things that are going, right? And so you're kind of building up to what you need to ultimately do. And so it got to where we were having to hyper communicate with a daily email or a couple times a week, updating on actions, updating on wins, updating on losses to keep them in the boat. We kept them in the boat for 7 months while we eventually bought one of these transactions, right? And that's okay, right? We had to figure the problem out. Understand that 100% of deadlines are negotiable, even contractual ones. So
I'll look at real quick, one more last thing. I think that it's, as Chad is saying, it is great to make sure that there is that open communication. But even on our side, look, there's a little give and take from the seller and the buyer. But you get to a point where the seller says, this is the price we're selling it for, we're not dropping down. It takes a team, all of us coming together and agreeing, look, this still doesn't make sense for us. And here's where we've got to get to. And so we got to a place where we took it back to the seller and we said, look, we know this is the price that you want, but here's where we need to be. And we dropped our price down, and we had to call their bluff because there was no way we could move forward with that price that they left off on. So what we did is we said, look, we understand this is the price you need, but this is the price we need in order to get this deal across the finish line. We sat silent, and we waited for them to make the next chess move. We were very firm on our price, and guess what? We did not act out of desperation. We were not the one reaching out to them. We were not asking multiple questions. And finally, they came back to us and they agreed to that number that we gave that we needed to have in order to make this deal work for our investors. So negotiation skills and power are so, so very important. And anyways, I'm delighted that our team was able to take this across the finish line and have it come out with a successful purchase price and a wonderful opportunity for our investors. It's super exciting.
There's nothing like the power of silence, Erin. I love that. And, to land the plane here, folks, I mean, we're talking about the right now. We're talking about troubles and moving sand right now. The key you have to remember as a real estate investor is you are an investor of real estate, not debt. And so what you have to do is you have to make do with what you have now. You have to make the best of the situation you have now. We're going to inject and make it into a better thing that it is that commands more rent, even if rent stops growing, guys and girls. Even if rent stopped and went to 0% growth for the next 3 years, it's okay. What we are doing on value add upgrades will still command a much higher rent, even if rent stops growing, than it does today. So the fundamentals, remember the fundamentals of the market, the fundamentals of the supply and demand in rental real estate are still there. And so if you're investing for the horizon, I think Marcus Millichap, CEO, says it's the best. I love how he says it every time is keep your eyes on the horizon, my friends, because that is what you're investing for, not the current situation today. So with that, we'll land the plane, everybody. It's been a wonderful episode. Thank you, ladies, for joining. And everyone, bye for now.
See you later.
Bye.
Bye.
All right, Real Estate Runway family, I really hope you enjoyed that episode. We got to go through a few nuggets about how you really pull off a closing in an environment where things are changing underneath you. We talked a little bit about, negotiations and how all deadlines are fiction and can be negotiated, and how you handle when the lenders are really spooked and changing out from under you. So anyway, as a reminder, focus on the horizon. We invest in real estate, not for transactional purposes, but so that we can grow wealth in the future. Okay, so keep your eyes on the horizon, as I mentioned in the episode. And folks, if you got any value out of this show today, please go and leave us a 5-star review, thoughtful comment. That is our favorite way to see gratitude, and it really grows the show. So thank you in advance for that. And until next time, this has been another episode of the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.